Hello, everybody, and welcome back to this channel on financial analysis. So in this channel, we are aiming to teach you the language of business finance and hopefully just take you through a set of accounts and pick out some of the key things that you might be looking for when you are analyzing a company. Please do remember, we are looking backwards, not forwards. So we are looking at historical information. So if you're looking for advice on where to the next share to buy, then this might be part of your investment thesis, your research, but there are other places to go for advice or opinions on whether you should be buying shares or not. Today, we are looking at Tesco. Tesco, most of you, any of you are based in the UK here, you will definitely know about Tesco. If you're overseas, then Tesco is one of the largest multinational groceries. So it's a supermarket here and also general merchandise retailer headquartered here in England, in Welwyn Garden City. It's the third largest retailer in the world, measured by its gross revenues, ninth largest in the world, measured by revenues. We're going to have a look at their financials. Before we do that, just to remind you that if you were, please do remember to like, share, and subscribe to the channel. So there's a subscribe. There's people always point in some direction, but I don't know where usually down below. But there's a subscribe button. Click on that. Do subscribe to the channel. Don't forget to like the video if you like it. Share it, and also leave your comments. Okay, so I'm always interested if you've got comments, whether you like Tesco, you don't like Tesco, whether you think it's a buy, it's not a buy. But please do remember to be polite when you are leaving your comments. And also, we do these as recommendations. So here we have from Scott Oldfield. There's a picture of Scott with a little Scott. So nice to see a little chap or little baby appearing as well. I'd love to see an analysis of Tesco, says Scott, or another supermarket chain, as food shopping has risen so much since COVID. I'd like to understand if this is supermarkets increasing profit or cost of food, cost of goods rising, or both, and your thoughts on the moves supermarkets have made over the last few years. Okay, so Scott, this is for you and for anybody else. I know there's lots of people out there who often use Tesco as a kind of a case study. So this is for you. So don't forget, these financials, here are the financials. They're available on Tesco's website. They're very easy to find. Lots of information about Tesco, who they are, what they do, where they operate, what their kind of philosophy is, their corporate governance, their approach to ESG, and all the other stuff is all contained in this report. But we are going to whiz through and we're going to jump through to the financials. And the financials, you'll notice quite a long way down actually, don't appear until about, well, we're almost over halfway through. In fact, here we are. So we're about halfway through the report and we finally get to the financials. So here is the financial statements of Tesco, and what we're looking at here. So you'll kind of see that they've got this extra column in here, which is kind of what they call exceptional items. So they've got, sort of non-exceptional items, then exceptional, and then the total. And I'm really interested in this total. So it's very easy for companies to say, oh, this is an exceptional item. It's never going to happen again. It didn't happen last time. But you'll notice that exceptional items for Tesco happen on a pretty regular basis, which doesn't actually make them that exceptional. So let's focus on this total column. We'll start off with the top. So here's the revenue of Tesco. So we are dealing in millions of pounds. So 57.9, nearly 60 billion pounds. Okay, so 57.9 billion pounds compared with the previous year, 58 billion. This was the weeks ended February, so this is kind of 52 weeks ended February 2021. So it's really, there's lots of pandemic in there. So sales didn't go down that much. They probably went down a little bit. And don't forget, there's lots of panic buying. Then they run out and people rush around to Sainsbury's, etc., etc. But these guys are, they're pretty stable. So there's the revenue. It's pretty solid. Now, the cost of sales, you'll notice here, this is the cost of all the food that they have to buy. So 53.4 billion. So I can tell you that this gross profit margin is about 7%. So in answer to your question, Scott, this is a low margin business. This is really, really low margin. So to give you an idea, Coca-Cola, they operate on about a 60% gross margin. BMW operate on a 15% gross margin. These guys operate on a 7% gross margin, which is basically they're taking the products, they're adding a little bit of extra price to it, and then they're passing it on to you guys. So if the price of the goods that they're buying goes up, then they have to pass that on to you guys, because they just have no space to be able to absorb that. The other question you asked was, are they absorbing this? Well, this is a highly competitive marketplace, and Tesco know that if Morrison's or Sainsbury's gets cheaper, for example, people are going to go and buy there. And as those prices of those staples goes up, people become increasingly cost sensitive and sensitive to those price changes. So I don't know. I don't have an inside track on Tesco, but my guess would be that they are, they're sourcing. They're very, very good at their logistics, so they're really keeping all of the costs down as much as possible, and that allows them to be very competitive at the point of sale. So there you go. It's a 4 billion profit on a 57.9 billion pound turnover. Here's the cost of running the business: 2.2 billion, up from the previous year, and therefore the operating profit has actually dropped off a little bit. The gross margin 7%, pretty constant. They've dropped a little bit because their admin expenses have gone up. I don't know why their admin expenses have gone up. I'm not sure they'd have benefited from furlough. They may have done a little bit, but don't forget the supermarkets were still open, or at least the kind of the online shopping was very, very busy. They've got some finance costs in here, so they're paying a bit of interest. So they're going to have some debt. And they're paying a little bit of tax. And so their profit for the year, 721 million, very similar to the previous year, 738 million. So they're kind of, that's a pretty low margin. Now, that's about a 2%, just so you're kind of, so basically for every pound you spend in Tesco, 2p actually is kind of is retained by the company for the shareholders, and all the rest of the money goes in buying the stuff that you've bought. That's about 93p they spend buying the thing that you've bought. They spend another about 4p actually running the business. They spend about 2p on interest and a little bit on tax. Now, what's interesting about Tesco is they got a big distorting figure in here. So suddenly we then get this profit on the from discontinued operations. Now, I don't know much about Tesco, but this talks about the sale of a business in Thailand and Malaysia, or Malaya, I think it was. So they've obviously they've exited a business. They've made a lot of money, and they, as we will see a little bit later on, they distributed that back to the shareholders. So if you were a shareholder at that point, you got a pretty nice little windfall check coming through the post. But obviously, if you buy shares now, you're not going to get it because it's gone. It wasn't there last year. It's not going to be there next year, and that's kind of why they put it into this exceptionals item. So there's the income statement. Nothing kind of nothing exceptional about it. We go down to the balance sheet. Couple of interesting things in the balance sheet. So first of all, so here's the non-current assets. So these are the things that they need to run the business. Now you're going to see a little bit of funnies coming in here. So first of all, the big number is property, plant and equipment. So these guys, they have a tendency, they don't rent their stores, they buy their stores. They're very cash rich, so they tend to buy stuff. They've also bought other companies, so there's a little bit of goodwill in there. And the right of use assets are the assets they got on hire purchase, things like, I don't know, the fleet of vehicles, for example, the photocopier in the corner, that kind of stuff. A little bit of a funny is this one here, which is loans and advances to customers. No, they're not saying, look, the packet of crisps is so expensive that you can pay for it over a period of time. But this is for those of you who are regulars at Tesco, you'll know that Tesco also operates a bank. It's a pretty small bank, and those are some of the loans that they've taken deposits in, and they've made loans out as part of their sort of their banking facility. So they are pretty small, but there is their bank. Current assets down the bottom. So inventories, they got the inventories, that's all the stuff sitting on the shelves in the store and in their warehouses. Very small amount of trade and other receivables, as you'd expect, because, you know, if you turn up at the checkout, Tesco and say, I'll pay you later, they'll say, no, you won't, you pay me now. So they don't really have a lot of trade and other receivables. And they've got some more of these loans and advances. So this is their kind of their loan book, these two numbers together. That's the bank sort of appearing in here. And then they've got some cash as well, quite a lot of cash, 2.5 billion sitting there. If we look at the bottom half of the balance sheet, and I'm just going to scroll down, I just want to compare these two. So the first part is the current liabilities. So the current liabilities, we kind of need to take these two numbers together. There's the current liabilities in the previous year. The 276 is pretty immaterial. It's not going to distort. It's about 16 billion. And traditionally, you may kind of be aware of the current ratio. We often compare these two numbers together. So this is a very kind of, you know, standard, what we call a liquidity test. It's called the current ratio, and we compare the current assets to the current liabilities. Now, the current assets, things we own, which are either cash or going to become cash soon. Current liabilities, things I owe and have to pay soon. Okay, now, when we compare those two, we like companies that have current assets which are greater than current liabilities. So when we see a number like this, it's ding-a-ling-a-ling, there's alarm bells. We're like a little bit nervous. Okay, now supermarkets are one of the few types of companies that can operate with what we call negative working capital. That's what those two words, those two numbers together. So that this number here, this net current assets, they've actually added it up for you. The net current assets is the current assets net of or less the current liabilities. They've added them together for you. And they said, look, it's negative, but we know it's negative. And the reason it's negative is because of their cash flow. Okay, and we'll look at that a little bit later on. In fact, we can look at it now. But what I can tell you is if you run these numbers, and I've done a little bit of calculation, so I'm just looking at it here, that it takes them on average, their inventory days is about 15 days. So from the day they buy something to the day they sell it, takes them 15 days. Okay, now milk probably goes a little bit quicker, and tins of baked beans, and you remember they'll sell electrical items and clothing, you know, so, and they may take a little bit longer. So an average 15 days, that's pretty quick. Their accounts receivable is 8 days. Okay, now when you think about it, you know, for you and I, their accounts receivable is basically zero, because as soon as we get to the checkout, that's it, we pay. But then the credit card's got to go through, and there's going to be some corporate customers. So 8 days, so 15 to sell the stuff, and then 8 days to collect the stuff. So 15 plus 8, that's about 23. So from the day they buy something to the day they get the cash in is 23 days. Their payment days to their suppliers is 59 days. Now, legally here in Europe, you have to be within 60 days. So it's interesting that they run it right up to that kind of that 60-day. So they will pay their suppliers in 60 days. They use their muscle to negotiate those terms. And that means that they're getting the cash in on 23, out on day 60, and then effectively that gives them an extra 35 days worth of cash. And that is why they can operate at this negative working capital. Okay, so if you're looking at that and you're thinking, oh gosh, Ted, I'm not sure about that, it's okay. This is a well-run company, and they know what they're doing. They're not going to run out of cash, believe me. These are famous last words, but I'm pretty sure they're not going to. So a few other numbers. So they got some borrowing. So here's the debt sitting in there. They've also got here's the customer deposits. So customer deposits will be part of their liabilities, but statistically, not everybody's going to go into Tesco and say we want our money back. So while it's classified as a current liability, they can probably treat it as a non-current liability, again relieving the stress on this one. So if you think about it, if everybody goes and takes their money out, it's what's known as a bank run, and Tesco are pretty confident that they aren't going to have a bank run. And then the other big liability is their trade and other payables. So borrowings is what they're using to fund the business. So that will be funding, you know, the purchase of, you know, new stores and that kind of stuff. And there's the lease liabilities sitting alongside those right of use assets. So the net assets, that's the assets less the liabilities, about 12 billion pounds, a little bit down from the previous year, and that's reflected in the equity. Just scroll down a little bit, there it is. So we can see the equity is 12 billion, and these two numbers mean that the balance sheet balances. So balance sheet looks pretty good to me. No kind of real, nothing, no alarm signals jumping out at me. Here's the retained earnings, and we'll notice that this is the movement in equity. So the profit for the year, let me just see if I can find it. Yeah, here we go. So if we look at this column here, just follow this column here down. This is the retained earnings. There's the profit figure. And then if we just scroll down a little bit, just keeping our eye that we're on there, you can see, in fact, I'll just scroll down to it. You can see there, there are the dividends that they are paying out. So they make this big profit and they pay it all out as a dividend. And then if we go on to the next year, sorry, the previous year, which is on the next page, there's the profit for the year 971, so much smaller. And we can see that the dividend payment is much smaller. So these guys, you know, really, they kind of, you know, they said when we made a windfall, we return that windfall back to our shareholders. Now, not every company does that. Some companies say we make a windfall, we're going to reinvest it on behalf of our shareholders. But Tesco did not do that. So there is the movement in equity. Last thing to look at is the cash flow statement. So these guys, the net cash generated from operating activities down the bottom here, you know, pretty strong cash flow. There it is. There's the cash flow from operating activities, 48 million in the previous year, 602 million in this year. So, you know, very, very strong cash flow. And then we just scroll down a little bit more. We'll see the investing activities. So we can see they made a lot of money from the sale of that business. There's the sale. So they've got a positive number here. And you can see up here, the previous year, the proceeds from the sale of property, plant and equipment. So to see positive numbers here, you don't often see that. Generally speaking, those are negative numbers because it's a company that's investing. And so these guys are divesting, and you're kind of like, well, you're going to do that. You know, if you do that for long enough, you know, you don't have any assets to run your business. So we'll probably want to keep an eye on that over the next couple of years and just make sure that they are, you know, properly investing. So you can see this is the kind of the purchase of property, plant and equipment. But don't forget, Tesco is not a company that really requires, you know, it's not a capital intensive business. It doesn't need, it could rent its stores if it wants to. What it really needs is that, you know, it's a trading company. So this kind of, this investment is less important. It could, if necessary, just kind of sell its stores and then buy them back and then obviously be paying rent. And then the last bit is the financing. So here we can see the increase in borrowings and the repayments of borrowing. So these two numbers together, this is the refinancing of debt. So they're borrowing money to repay loans. They're doing a little bit of share buybacks. There are the share buybacks and the dividend payments we can see here. And you can see obviously big dividend payment in this year, lesser dividend payment in the previous year. And you're not going to see a big dividend payment in the next year. So there is the cash flow. So let's, bearing in mind all of that information, let's go and have a look at their share price and see what it has been doing. So here's the share price of Tesco. They are nearly 21 billion market cap. And that market cap is, don't forget, the balance sheet is about 12.5 billion. So there's about just under 8.5 billion of kind of goodwill cooked into that price, so to speak. Price to earnings ratio is 3. And for those of you who are kind of, so if you're not sure that price to earnings is you know, the price, that 20 billion, you know, what multiple of earnings is it? If you were to turn that upside down, you get about a 30% yield. And you kind of think, wow, that's a buy. But of course, it isn't a buy because there's that one-off kind of profit from the sale of the business. We're not going to see that next year. So usually I'd sort of say, oh, wow, this is a screaming buy. But this is not a screaming buy. You know, we kind of need to strip out that kind of and look at it, the underlying performance in terms of the business rather than getting distracted. And again, that dividend yield looks quite low to me, actually, 3.39%, given that they just made that big dividend. But maybe that's based on more recent dividends. So there we have Tesco. Tesco, as I said, often used by lots of companies. I know lots of finance trainers who enjoy, using Tesco as a sort of a standard set of accounts that kind of gets rolled out. So if you are, I don't know, you're an MBA student, you're studying Tesco, you've got to do a presentation on them. Maybe you're studying for your CFA, your accountancy exams, and you've got to look at a company. There is Tesco in a nutshell. So I hope you found that useful. Once again, please do leave your comments. If you want me to look at a company, then also just let me know which company you want me to look at and why. Why is very important to me, because it sort of gives me a little, so I quite like Scott's comments as to why we should be looking at this. I think that Tesco, it looks a pretty solid company. It's good at its knitting. It kind of gets into trouble when it expands outside its knitting, outside the basics. Don't go anywhere near America, they've learned. But it's a decent company. It's all about logistics. It's all about efficiency. It's all about trying to buy stuff as cheaply as possible. They bought Booker, for example, the wholesaler. Buy stuff as cheaply as possible, get it to the stores as cheaply as possible, and keep your prices as low as possible, and then you're competitive in the marketplace. And that's kind of the formula for success for people like Tesco. So I hope you found that useful. Once again, don't forget to like, share, subscribe, and I look forward to seeing you on the next video.